and thank you for joining us for the final session of our in-house counsel CLE webinar series, Grow, Protect, Operate, and Finance. Before we get started, I have just a few housekeeping notes. For the benefit of all participants, attendee lines have been muted. Should you have any questions that you would like to submit during the event, you may submit them through the chat box at the bottom of your screen. If we cannot address your question during today's webinar, we will follow up after the program. Please note that today's webinar will be recorded and circulated to all registrants via email after the event. Should you have follow-up questions at that time, please reach out to any of the key contacts listed in the email communication. Please note, Dentons can only issue CLE credit for attendance during the live broadcast of the webinar. The following is a very important message regarding CLE credit. The webinar window must remain open for the entirety of the program, and it must be the only window on the forefront of your screen. WebEx will detect if you minimize the program or use the computer outside the webinar software, and this will prevent your earning CLE credit. One other important note, if you have a New York, New Jersey, Pennsylvania, or Kansas license, please be sure to listen for the code word given during the program. When prompted, you will need to enter the code word into the Q&A section of the screen. If you don't have a license in these states, you can disregard this. Now I'll turn it over to our first presenters.
Great, thanks, Casey. We're very excited to be presenting today in this series. And I'm Mark Lloyd. I'm a partner and co-leader of the Tax National Practice Group. With me are, and I primarily focus on state and local tax. I'll spare you the details of anything else at the moment, but I'm really happy and proud to have with me Bailey Rose, who's also a partner in the Tax National Group. She focuses her practice on state and local tax as well. And Ryan Dunn, who is also, of course, a partner in the Tax National Practice Group. And he focuses his practice on international tax and domestic transactional tax. So we have tried to comb the tax issues that we see a lot and consolidate them into a handy format for you all to experience, with us as we go through talking about various recurring trends and issues facing our clients. So we'll be talking about remote work and implications for employers, various aspects of that, marketplace facilitator rules and updates. Certainly those are sales tax issues, obviously, for those who may or may not be familiar. We'll also talk about asset purchases and sales and use tax implications of those, and some tax saving strategies on acquisitions and divestitures. So first up, we'll be talking about remote work one more thing. We'll all kind of be chiming in on certain slides. So one person might take the lead, and then others might make comment. That's intended to make this a little bit more conversational. And again, appreciate the opportunity to be with you guys today. Take it away, Bailey.
Thanks, Mark. Yes, I echo all those sentiments. We're excited to talk with you today. There's obviously so much going on in the tax world. There always is, but of late, there are definitely some things that have cropped up given our unique circumstances that we all find ourselves in. And as we speak today, feel free to drop questions in the chat. We're always happy to pause and address those. Or as Casey mentioned at the beginning of the presentation, we're also always happy to catch up with you all after the presentation via email or phone. Just drop us a line. So we'll start today by talking a bit about remote work, which I'm sure as employers has really been something that you all have talked about with with your client, with your employer, your companies, because as you can see, I'm working remotely. Ryan is also working remotely. Mark is in our offices. But, a couple of years ago, we would have all been, really sitting in the same office building, and now we're kind of spread out a little bit. So we're kind of a living example of this, and I'm sure that you all are, experiencing the same thing. So obviously, the trend over the last couple of years, and even before the last couple of years, where remote working arrangements were already on the rise. But now that we're a couple of years into this pandemic, these trends kind of appear to be here to stay. A couple of things of note are that searches for remote jobs are at an all-time high. There was a study done using some job search software like Monster.com, Indeed, where they tracked the search terms that candidates were looking for in jobs that they wanted. And from June 2019 to June 2021, candidates looking for remote working arrangements increased by 360%. So that's pretty huge. And as you can see, that's even, beginning before the pandemic began and continuing even after some of those pandemic restrictions were lifted. In workforce surveys, 2/3 of employees in banking, finance, accounting, insurance, and IT have stated that they think that their jobs could be done entirely remotely. So they could continue working remotely and feel like they had no drop off in productivity. So those industries in particular are seeking more and more remote work arrangements. The finance and tech industries seem to be kind of leading the charge in the transition to permanent remote work. So employees in those sectors are really kind of, asking, demanding that they have the opportunity to work remotely if they want to. And their employers seem to be kind of agreeing with them and letting them come to the table with those arrangements. And so again, even as we see the pandemic restrictions being lifted, people returning to the office, there's still a really large chunk of the working population that increasingly say they want flexibility to work from home or even a permanent work from home arrangement. So remote work really is going to be here to stay. So what does that mean for you? So, this is a really important consideration when we're thinking about the obligations of employers and employees for their taxes, for state and local taxes in particular. As the pandemic began, a lot of taxing authorities we saw were kind of offering some grace during 2020 for pandemic-related temporary remote working arrangements. So, some jurisdictions were coming out and putting out formal guidance, kind of saying, hey, we understand this is happening. We're not going to be pursuing this for the time being. But now that we're a couple of years into this and, some states, some localities are starting to see revenue impacts because, maybe, a large amount of employees have started to work remotely and they're no longer paying tax, in a particular locality, a particular state, particularly in some of those, more expensive cities. Like we saw lots of people leaving New York City, for example, during the pandemic. As those impacts are hitting their books, they're going to start becoming more and more aggressive in actually figuring out where employees are located, where employers are doing their withholding, and kind of going from there. So it's a really important time now for employers to begin reviewing current policies and your practical kind of on the ground reality to prepare for these federal, state, and local tax implications. And we're going to talk through a number of these today. They include state tax nexus for sales tax purposes, withholding and employment tax obligations, corporate income tax compliance, or kind of doing business type of questions, permanent establishment questions for foreign businesses, and also local license taxes. So as you can see, even though these are questions about where your employees are, they can have impacts all across the board for each of the particular taxes that your company may pay. And Mark, did you have something to add? Yeah.
Yeah, I just wanted to build on this, just on this slide, just a little bit. And that has to do with, some of y'all are probably thinking, oh, well, how do I figure out where my employees are? And I think we've always kind of dealt, or some employers have always kind of dealt with this, where, for example, salespeople are outside of the office, perhaps working in multiple states. And so I think this issue has existed. Excuse me. It's just been made more prevalent, by office workers, who are now doing remote work. So there are, a couple different, approaches you can take. There's some apps and software that can enable you to track folks. I mean, some like perhaps maybe using your phone or your employee's phone. Some employees might not care for that a whole lot. Who knows? And sometimes you can take probably, I know some employers that we've talked to, some of our clients are thinking about practical approaches. So for example, if you're always on like a 4-1 or a 2-3 or a 3-2 or a 1-4 kind of schedule, whether you can practically do that. I know since in-house counsel are listening to us, you're probably thinking, oh my God, I really don't want to track my time. That's one of the reasons why I'm not practicing in the law firm. And I don't know if we need to quite get there, but you need to think about, the payroll departments are going to need to think about, especially going to, and to the extent we probably several of these compliance issues are going to revolve around data and how can we support, the positions that we're taking and how do we figure out, where we need to comply. So these are things that we're seeing. And I think some of the practical implications just need to be kind of thrown out there.
Absolutely. Thanks, Mark. So first, we'll talk a bit about sales tax and income tax implications for employers. So as many of you probably know, states can impose a sales tax when the company has a physical presence in the state. So the big buzz over the last few years has been as a result of the Wayfair decision, which allowed states to start taxing remote sellers who didn't have a physical presence in the state based on these economic nexus thresholds. But don't forget that the original standard was, if you have a physical presence in the state, then the state can impose a sales tax. And that includes employees. So all of a sudden, if you begin having employees who have started working from home, particularly if you have offices that are kind of located right on the border of a state, or you've got like a large number of employees who maybe have decided to move somewhere and kind of permanently relocate, they might be in a state where you didn't have a physical presence before, and now you do. And so that can trigger sales tax collection and reporting obligations, even if you're not doing a large volume of sales in that state. So very important to kind of recognize that issue could be out there. Also, many states impose a corporate income tax or a franchise tax on taxpayers who are doing business in their state. And so doing business can also include employees. So, all of a sudden, if you've got a large group of employees in another state who have set up home offices and are working there permanently, that can all of a sudden translate into your company doing business for the first time in a state. That being said, there is an important limitation on the ability of states to impose that tax on you. And that's PL 86-272. And that prohibits states from imposing an income tax on a taxpayer whose sole connection to the state is employees who are engaging in mere solicitation. So if you have employees who are just kind of sales employees, maybe they're making calls, they're trying to kind of just bring in new contracts, things like that. If they're just doing solicitation activities, that is not enough to rise to the level of doing business in that state, and the state is not supposed to impose an income tax for that purpose. But you want to be aware of that. But states are just becoming more and more aggressive and trying to kind of get around that. So you just want to be sure you're reviewing, first finding out where your employees actually are located, and then reviewing very carefully the activities that they're doing there. Yes, Mark.
Yeah, and I think on the 86-272, this has always been the case. The states take a very narrow view, and while this looks like a really broad provision, you really need to make sure that your tax folks really need to make sure that the position is documented well, because we all know that salespeople like to sell, and they're going to do whatever it takes, to make the sales, and well, they should. But sometimes what they're doing could go beyond the scope of public law 86-272. So it's really important to ensure that not only do you find out what they're doing, you work with the sales folks and you document that, because if you're taking those kinds of positions, it's really important that you be prepared to defend them. Thanks, Bailey.
Another obvious example here for implications for employers is employee withholding and payroll tax implications. So an employee is typically subject to tax on all of their income in the state in which they reside. So that's kind of the default rule. But an employee is also subject to income tax in the state where the employee performs services. And an employer is obligated to withhold state income tax on those services unless there's a safe harbor or a reciprocal agreement in place among kind of a group of states. So only a few states actually provide that safe harbor, which sort of allows an employee to work in the state for up to a certain number of days without triggering their obligation to pay taxes, and thus the employer's obligation to withhold. So that might just be a certain threshold where the state says, if you are only working in the state 30 days out of the year, it's okay. We're not going to require you to pay tax to us. But only a few states have those safe harbors, and most of the rest say, you've got to pay on day one. But that being said, a lot of states do have a reciprocal agreement among kind of neighboring states. This is a really common thing that allow you to exempt state income from tax in the state in which the employee works. So effectively, the employee's income is subject to tax only in the state of their residency. So Kentucky and Indiana have an agreement. Kentucky has one with several of the surrounding states. But this kind of makes it a little bit easier where, the employers only got to withhold in one state. The employees only got to pay the tax in one state. They don't have to worry about figuring out credits for tax paid in one state instead of the other. So this is helpful. But that being said, there's obviously been a lot of shakeup with employees working in new states. So certain other states have rules and requirements for withholding that depend on whether the employee is working from home for his or her own convenience or the convenience of the employer. So New York, Delaware, Nebraska, Pennsylvania, and Connecticut are examples of states that have this issue. Localities may also have license or occupational taxes based on where work is physically performed. So here in Kentucky, we have occupational license taxes in cities and counties where the tax is based on the location of the work performed. So not the location of the company, the employer, it's the location of where the employee is actually physically performing work, and that's where the tax is to be paid. So each of these issues can create withholding obligations for the employer. Yeah, go ahead, Mark.
Yeah, so and this has all only been exacerbated by the drive to remote work, as a result of the pandemic, where instead of just folks potentially being absent, or in another state for a couple of days, maybe they're at a conference or just a one-off visit to the factory, they're literally working from a different spot 20% of the time, 40% of the time, 60% of the time, quite a bit. And then there's a question from the audience: is the full amount of income subject to tax by both? And the answer to that is yes, but. So let's say for example, I'm working in Kentucky. Let's say I'm in Indiana, for 20% of the time, Indiana. So I pay a tax on all my income to my resident state, right, which is Kentucky. Let's say Indiana then says, Mark, let's say there's not a reciprocity agreement. Maybe I should have picked, Missouri, let's say, I don't know, California. Let's say I was in California 20% of the time. California subjects 20% of my income to tax based on the number of days that I was in California. So I've got California tax, and which is 20% of my days, and then I've got Kentucky tax, which is the whole thing. Then since I'm resident in Kentucky, I would generally get a credit, for the amount paid to California up to the equivalent tax rate in the state that I'm in. So I would be kind of behind because the California state tax rate is much higher than Kentucky's. But nevertheless, that's the kind of the safety valve for double taxation as it relates to that. So technically, I've got two filing requirements or two withholding requirements if I'm an employee in Kentucky, and I'm also doing work in California.
And it's kind of important to note, and we'll talk about this a little bit more in a few minutes, but it's important to realize, that the obligation is on the employee to pay the tax that they owe on their own income, but at the same time, the employer does have withholding obligations that arise. And so you also need to recognize as the employer that when you're dealing with these issues, there's going to be some paperwork on the front end, particularly if you're in a brand new state. So you're going to have to register with that state to register to do employer withholding and payroll taxes. You might need to register with the unemployment insurance commission of the state, workman's comp. So these things can get very bureaucratic very fast. So it's important to really be proactive about figuring all that stuff out. Yeah, go ahead, Mark.
And then the localities, hopefully, Bailey, I'm not stealing your thunder, but the localities are I don't want to say crazy, but it is crazy, dealing with the localities, because you can end up dealing with, like, it's particularly in this area of the country where you've got Kentucky with local taxes, Indiana with local taxes, Ohio with local taxes, or New York City, for example, with high local taxes, and there are other jurisdictions where there are local income taxes, where you've got you might have, even though you might be within the same state, you have issues with, oh, well, I've been paying 100% to the city I'm working in, but now I live in city B. In city B, let's say maybe they don't have an income tax, or maybe they have their own income tax, and so you're ending up with difficulties on the local side too. And the local information, employers are not used to collecting either. It really just adds a extreme layer of complexity.
Yes, and especially in those localities, it can be for a very small dollar amount. So it can really be tough, and it's something that you want to really look into. This is something where it becomes both a business decision and a compliance decision as well. And we just have provided an example here of Kentucky as an example of a state that's kind of given some guidance over the last couple of years as to what's going on. The Kentucky Department of Revenue issued this frequently asked question response and said, KDOR does not administer licensed occupational or other excise tax imposed by localities. For Kentucky state income tax purposes, employers employing Kentucky residents and or non-residents who reside in states with which Kentucky has a reciprocal agreement will not need to change their current withholding practices during the period when these employees are working from home. Requirements for withholding tax in either case remain unchanged by restrictions related to the COVID-19 public health emergency. So Kentucky's kind of said, you don't need to do anything as long as we have a reciprocal agreement. But notice down here, related to income tax nexus for employers, they said that they're going to continue reviewing state income tax nexus determinations on a case-by-case basis. So they're not really putting out any affirmative guidance here, but they're saying we're just going to look into it. No matter what's going on, we'll review the facts and circumstances of your case, and kind of for tax practitioners like us, that's code for saying, we very well may tax you if we decide to. So kind of keep that in mind. And if the states and localities weren't enough, there's also some international implications here, and I will kick it over to Ryan to talk through some of those.
Hi, everyone. So not only do employees work, interstate, they want to be mobile. There's also international remote work that's kind of, in my experience, historically, this usually comes up when you have, let's say a foreign company acquires a U.S. company. They want to send an employee to the U.S. to kind of help integrate that new acquisition into the greater group. You could have US based employees going to, let's say, Singapore to get trained or to be trained. That's the way historically I've seen these questions come up. Now it's a little bit different, where you've got this flexibility of kind of working from home, and some employees are saying, I'm based in Canada, can I go to Florida for 3 months during the winter and kind of thaw out? Or if they're in the US, they want to, maybe do tourism in Costa Rica and rent a house for a couple months, and it'll be kind of a vacation / where they're working during the week, and then on the weekends they're kind of, they're on their vacation. And so things that we're seeing more of that. We're getting questions from employers saying, can I allow this employee to go to this foreign country for some amount of time? And this is really a complicated issue. And I just want to go over some of the things that you need to be thinking about. So number one is taxable presence risk. Is allowing this employee to go to another country going to cause you to be subject to tax in that country? It could be the answer to that is no. Maybe there's a treaty with that country and you can rely on the treaty to avoid becoming subject to tax in that country, but maybe you still need to file an income tax return in that country in order to actually claim the treaty benefits. Payroll tax filings, this is going to be sounding familiar. It's a lot of the same issues with the states. So you may need to file foreign, payroll tax filings or, withhold foreign income tax on the foreign sourced wages. Visa compliance. So this is an additional complication. Some employees want to do this as kind of a vacation. Maybe they're on a tourist visa. The question there is whether they actually have a legal right to work. I'm not an immigration attorney, but I think if you're on a tourist visa, you generally don't have a right to work. So that's an issue. And then on the other hand, if you want to actually comply with all the visa requirements and get the proper visa, does that require the employer to actually sponsor the visa? And again, that's just more kind of bureaucratic, paperwork that you need to figure out. There's potential foreign employment law that you could become subject to. And the employee also has it's his or her own set of issues. Number one, they probably want to avoid becoming a resident in the foreign country. So they probably want to limit their time and count their days and make sure that they don't become a resident. But also, even if they can avoid residency, they'll probably be subject to tax on some of their foreign, their income while they're in that foreign country. And they may have to file a tax return in the foreign country. And so it's not only just a headache potentially for the employer, but also the employee as well. And so I just want to go over one example of a kind of what I call an inbound illustration. So you've got, let's say, a Canadian based employee coming to the US. The question here is first, whether by having the employee in the US for some amount of time, is the foreign employer going to be engaged in a US trade or business? This is a bit of an amorphous standard with kind of some bright line rules and some safe harbors. So, one of the bright line rules is if you're performing personal services in the US, you're going to be engaged in a trade or business. And there's also some safe harbors that say, if you're only doing this type of trading activity, let's say, you wouldn't be ETOB. The next slide, please. Another question is, so income tax treaties. Now, whether you allow an employee to be kind of mobile like this might depend on whether you have a treaty with the foreign country. So circling back to my example of the Canadian-based employee coming to the US, we have a treaty with Canada, and that generally would allow, assuming the foreign company qualifies for benefits under the treaty, which is its own complicated analysis. The question is whether the activities of what is happening in the US, does that rise to the level of a permanent establishment? And that things you need to be thinking about is just, what is the employee going to be doing? How long are they going to be in the country? What are they going to be doing? Where are they going to be doing it from? Is it, an office of the foreign company? That's probably going to be a problem. If they're doing it from their own hotel room, it might not raise to the level of a PE. But it's really kind of a fact-intensive analysis that you need to be looking at to determine whether there's a PE. And now for the employee considerations, again, there's the residency rules that they need to be concerned with. And I just kind of one example of the complexity and just how it's frankly a pain. Again, in that example of Canada employee coming to the US, the Canadian employer would need to withhold US income tax. But relying on the treaty, the foreign employer may be able to avoid that requirement, and so that they would only withhold Canadian income tax. But in order for that result to be reached, the employee in the US would need to qualify for treaty benefits. And in order to claim the treaty benefits, the employee needs to have an I-10, which is kind of like a social security number, but different. So they need to have an I-10 to claim the treaty benefits. In order to get to the I-10, they actually need to apply for a social security number first and be denied for it. That process could take a couple months. And then once they get denied for this social security number, they could get the I-10 and then rely on the treaty and avoid this withholding requirement. And even doing all of that, they probably still need to file an income tax return in the US. And, when you talk to employees about this, they just might say, kind of forget about it. I don't want to bother. It's too much of a hassle. I thought I saw a question come up, but maybe it was deleted.
Yeah, I think there was one, and then the person said, never mind. So,
All right then.
So we'll wrap up this section, just kind of with considerations for you all, what you can do proactively. As Mark alluded to when we kind of started talking about this, it's really important for you to gather your relevant teams, whether that's HR, legal, accounting, payroll, tax, to best understand the current state of remote work at your company. So you're going to want to gather key information from employees. Ask whether employees have transitioned to remote work permanently. Are they doing it just a couple of days a week? Where do they live? Are some of them working remotely just part-time? Are they traveling? Are there policies that you have in place currently for employees? Do you need to tweak those policies or update them? Do you have a system in place for recording work location? So some of those apps that Mark mentioned, that this is where you're going to want to take stock of what resources you currently have available and see what ones you need to look into getting to kind of fill these gaps. And obviously, depending on the size of your size of your company and the type of teams that you're working with, this could be a really easy solution or it could be a really complex one. So it's, again, really important to have those key employees in the room to help you make those decisions. You want to ensure that employees understand their personal tax liability versus your liability as an employer for withholding. So, frequently we'll have, kind of letters, we'll help employers draft letters to their employees that basically explain, you probably want to engage your own tax professional to look at this with you. We are doing what we believe we need to do as the employer. However, you need to understand that you may have liability as well. And, as I'm sure you can imagine, being employees of companies yourselves, when your withholding is not done correctly, it can be a real source of frustration for employees. So you want to be really proactive in trying to head off any issues that come up. And then you just want to review information and then identify any new risks or compliance obstacles. And this is a good opportunity to work with your your legal team, your tax team, to make sure that everything is set up the way it needs to be and that you are good with the system that you're going to have in place going forward. And now we will kick it over to Mark for a discussion of marketplace facilitators and providers and some recent updates to those types of laws.
Thanks, Bailey. And one more comment on the prior slide that I wanted to make was oftentimes you might think, oh, when are the states going to go after, us, or who are they going to go after? And I think you can extrapolate the fact that most states are interested in highly compensated, individuals. So they're much more likely to go after, for example, actors, sports figures, etc., because, their presence in a particular state for a day might be, a good amount of money, for example, which is why they often have these really low or no requirements. So that would probably mean your C-suite folks, that they might be more interested in. That's not to say that, you can't make risk-based decisions, but you need to be cognizant of where the risk is gonna be. So, okay, and let's move on to marketplace facilitators. We get a good number of questions on this topic, and let me explain it, I guess, first, just a little bit of background. A marketplace facilitator sells products on behalf of individual sellers. And we think of when this first came up, when this issue first came to light, we would think of Amazon or Etsy, the companies that are providing markets essentially, for others. And so what these marketplace facilitator laws do is they impose an obligation, on the marketplace facilitator to collect and remit sales tax to states on behalf of the individual marketplace sellers. So this was kind of on its way in as the Wayfair case was kind of winding its way up. So the states thought, well, we can't go after the individual sellers, we'll go after, the facilitators of the markets. And of course, it's a lot easier to collect, to make Amazon, for example, collect sales tax than it is to make, 1,000, a million little, 100,000, whatever, little sellers collect and remit sales tax. So it was the way the states were going to close the gap of compliance. Before these laws, there was no mechanism to force the marketplace facilitator, to collect and remit sales tax, because they weren't the actual seller, and therefore they could argue, and rightly so, that they weren't responsible for collecting and remitting the tax. And so these are very relatively new laws, and they're not completely uniform either. There are various differences in each state's marketplace facilitator laws. One thing they do have in common is they generally have thresholds similar to the economic nexus safe harbor rules that regular sellers, regular remote sellers, have 1,000, 100,000 in receipts or 200 transactions. Now you can imagine that if you're any marketplace facilitator of any consequence, you're going to way outstrip, these very low thresholds very quickly. And as I noted, the requirements vary by state. So this can be a really big, issue. Let's stay on the prior slide for just a minute longer while I want to make a couple comments on this. So when we're asked these questions, it's typically not by, the obvious marketplace facilitators. It's by companies that don't think that they go, oh my gosh, I think we might be a marketplace facilitator. So we often end up kind of looking at whether or not some program or some new business model that our clients are engaged in, and whether or not that makes them a marketplace facilitator. And typically, one of the things that you really want to look at is whether or not there's some type of financial transaction. Are you collecting the money from one party and then take that money and then remitting it to another? Are you somehow facilitating the sale, in that process? So are you an agent? Do you think to yourself, God, are they an agent? Maybe, maybe not. In those kind of situations, you want to think to yourself, is this what we're doing? And we've really kind of explored the fringes of this, and most of the time the clients don't want to be marketplace facilitators, so they're basically trying to figure out how can we, do what we want to do without crossing that boundary. And of course, the boundary is not a bright line. It's there's a lot of no man's land between the black and the white. There's a lot of there's gray in between. Okay, so on the next slide, you'll see that when you do have these the states do have these marketplace facilitator rules, tend to fall into a couple of different buckets with regard to compliance. So sometimes they just bundle all of their sales together. Well, I think that's the bottom one. Sometimes there's kind of an election, and sometimes they have to separate it. So in other words, I make my sales here, and then the marketplace facilitator sales fall into a separate bucket. And sometimes, the states will require certifications when the marketplace facilitator is going to collect and remit. Oftentimes, I think as a practical matter, though, when you're registering for sales tax, you're going to have to basically declare whether or not you're a marketplace facilitator. And of course, if you do that, you're essentially there's a communication with the state. Bailey, did you have a comment on this slide? No.
No, just you can kind of think about that in terms of, if you're shopping on Amazon, there are items that you would purchase that are sold by Amazon as the seller. And so when you're using Amazon.com to buy a product from Amazon, that's their own website. They're providing their own market for their goods. But then, of course, there are lots of third-party sellers that sell as well. And that's where the kind of the marketplace comes in. And that's where you can sort of have these states that delineate between the two, you as seller and marketplace, and then you as just the marketplace.
And so you can see now that the coverage of every state with a sales tax has, a marketplace facilitator rules now. There were some holdouts for a period of time. It would be intellectually interesting if you wanted to look at the historical progression, of the map. At one point, obviously, there were 0 marketplace facilitators, and then it increased, quite a bit, quite rapidly. And then there were a couple of holdouts. I think it was Missouri and Florida, I think were a couple of the last ones. And then ultimately it's now, as the slide shows, it's everywhere. So if you've got a sales tax area, they've got marketplace facilitator rules. And now let's kind of move on to asset purchases. If your company, and we see these a lot too, because the market is there are a lot of transactions going on. A lot of companies are buying, selling businesses, and we get a lot of questions about asset purchases. And sometimes issues come up even in relation to stock purchases, but we're going to focus on asset sales, which are very prevalent. So think to yourself, are you looking to acquire another business? Are you looking to divest of a business? Especially if the sale is structured as an asset sale, which many are, there can be issues. And when I say that, you don't really want to pay sales tax on the entire transaction, right? So you're going to have to think about how do we break this down so that we get to a right or a manageable answer, for example. So certainly don't want to pay sales tax on intangible property like goodwill, et cetera, customer lists, for example. And you don't want to pay it on real property, buildings, land, et cetera. You might have to pay real estate transfer taxes on those, but that's yet another thing that we end up with questions on. But focusing on sales tax, you also want to stay away from having to pay sales tax on inventory, for example, office equipment, raw materials, things like that. Although office equipment, you probably are going to end up having to pay sales tax on that because there's not generally a really good answer to that. There are also some planning mechanisms that can be done if sales tax is a big deal to a transaction, which it can be if you're talking about 6, 7, 8% added on to the cost of tangible personal property. In some deals, that can be material, and it ends up being a point of negotiation. So what can you think about with regard to exemptions? There's several here. I already noted the intangible personal property, which isn't just goodwill. You might have customer lists and other things that is not a sale for tangible personal property. Occasional sales, I'm going to skip down to the bottom. Purchases for resale. So oftentimes, you don't want to have to pay sales tax on inventory, right? I mean, that makes no sense. So oftentimes, that's kind of a sale for resale. And then circling back to occasional or casual sales, while many folks think, oh, this is not, we're not going to have to pay sales tax on this. It's we don't sell our business all the time. This is just not going to come into play. It happens all the time because the state's rules for what is a casual sale or an occasional sale can be difficult to come within, and they're very factually intensive. So they're meant to exempt. I mean, they're certainly meant to exempt certain asset sales for sales of businesses. But think of the rural legislators' intent when they're putting these into place, and garage sales and things like that. So when you want to get the transaction within that occasional sale exemption, you have to be very mindful to see if it'll apply. And you also have to think, well, what happens if it doesn't? So a lot of times when we're talking about these exemptions, etc., we're doing it with the thinking that we got to make sure we've got a fallback in case the state tries to disallow the occasional sale exemption. So it's just like trench warfare. You got to dig multiple trenches if you want to win. It's kind of like it's obviously World War I tactics, but it worked in World War I. Generally works in this context too. Have other kinds of exemptions. Perhaps you're selling to a nonprofit or a governmental entity, and there are a lot of industry-specific exemptions. For example, manufacturing machinery and tools and supplies, raw materials, things like that. In Kentucky, we've got a very specific exemption for machinery and for new and expanded industries. So unlike other states, for example, Ohio, Indiana, which have more all-encompassing exemptions, there are some states with narrow requirements, like here, it's to be machinery used directly in the manufacturing process. Those two are often, those two are very common examples of requirements incorporated for the first time into plant facilities. That's kind of special, and there are different states with other, similarly special requirements. And not replace other machinery. Again, that's another kind of special requirement. So when you're looking at and you can see there's an example for Indiana, you can't just go, oh, it's manufacturing machinery, it qualifies. You really have to delve a little bit into the details. And then you got to document. Make sure that you can justify the positions that you've taken, whether it's via papering these things, making sure the exemption applies. Also taking into consideration drafting the APA, for example, making sure there's a purchase price allocation in the APA. Ultimately, can be helpful in many different contexts. And also, there are bulk sale disclosure and filing obligations, which basically mean if you're buying assets, you could still end up buying, the tax liabilities of the business. So you have to really be careful about those. And the other thing that we see is due diligence on sales tax. So all that marketplace facilitator, all those remote sale items that we were talking about, if you're buying a remote seller, or if you're going to sell a remote sales business, you're probably somebody's going to go through that a bit with a fine tooth comb to figure out where where these assets, obligations, issues arise. And the last bullet I think is important when you're negotiating the tax provisions. Understand that there can be a difference between statutory liability, which is imposed by statute, you can't really contract out of, versus contractual liability, where you're essentially shifting the burden via the contract, and then your reliance is on your indemnities, for example, your reps and breaches, etc. So there can be issues with that. And now, Bailey, did you have anything else to add on this slide?
I just wanted to point out we have one question in the chat, which is what about asset sales between affiliates?
Oftentimes, asset sales between affiliates can be handled, through an occasional sale exemption, and I would still follow all these ideas in order to try to document that. Sometimes if you're transferring between affiliates, and you can do that, and instead of doing a sale, you can do a drop down, for example, or some other transfer without consideration. That's another kind of planning tool that you can consider.
And so, as mentioned at the beginning of the webinar, we need to take a brief moment to satisfy CLE requirements by delivering the following code word, which is finance. All New York, New Jersey, Pennsylvania, and Kansas licensed attendees must type the word finance into the Q&A section on the right-hand side of your WebEx screen. Please make sure to hit the send button so that it registers. In case you miss it the first time, the word is finance. So if everyone can put finance into the chat, the Q&A, that would be great. Make sure that it's been submitted, and we will now wrap up with our tax saving strategies on acquisitions and divestitures with Ryan.
So I just wanted to talk a few minutes. We've got a couple of minutes left. I want to talk about Section 1202. And this is just another thing to put on your radar. This is really a great benefit that doesn't come up that often, but when it does and it works, it's really a complete home run. It's like you get fantastic results. And so the highlighted text in red is really where the magic happens. And so this code section's been around since I think the early 90s, and it's been amended a few times. And essentially since 2010, it allows you to exclude from tax 100% of your gain on the sale or exchange of qualified small business stock held for more than 5 years. Next slide. And so just to illustrate the benefit, you can have each shareholder can exclude $10 million of gain from their income. And so per shareholder, it's really per taxpayer. And so there's strategies that you can use to kind of ratchet up the benefit and effectively create more taxpayers. You could do this by gifting your shares to someone else, by creating a trust. There's ways to increase this benefit. And so the benefit is you get the biggest bang for your buck if you're like kind of just doing a stock sale, but there also can be a benefit if you're doing an asset sale where, the corporation would sell its assets and then liquidate and distribute the cash to shareholders. That distribution could qualify for an exclusion under Section 1202. And the reason why this is important to put on your radar is, you may be at a company where your shareholders are expecting to get 1202 treatment. And so there's things that you might need to be aware of, or maybe you're going out and acquiring companies. And this is something that you could kind of mention to potential target shareholders as a benefit to them, and that would really build a lot of goodwill. And we can move on to the next slide now. The major requirements here is that you need to have C corporation stock issued directly to a taxpayer. This is pretty much just saying, you can't buy the stock from another, on the open market or from another shareholder. You really need to be getting the stock directly from a C corporation. At all times before the issuance of the stock and immediately after, the corporation needed to have less than 50 million in gross assets. Don't get distracted by that 50 million number. It's really the tax basis of the assets that you're looking at for purposes of this test. And so you can have theoretically the assets of the company are worth $200 million, but the tax basis is maybe insignificant or it's under 50 million. The stock needs to be held by the shareholder at least 5 years. That's really kind of a cut and dry requirement. One thing to note there is that there's possibilities to kind of roll over your 1202 stocks. So say you had an interest in a corporation and you held the stock 4 years, then there's a sale. Well, you may think, oh, well, I didn't reach 5 years. I'm kind of screwed. I can't get this benefit. Well, you can actually roll over and sell your stock and get stock in another company that qualifies for 1202, hold it for 1 more year, and then get this amazing benefit. Then lastly, during substantially all of the taxpayer's holding period, the corporation met the active business requirement. This is a little bit more complicated. There's some ambiguity as to what substantially all means. I generally tend to think if if 4 out of the 5 years this test is met, you're probably good to go. And here there's another kind of taxpayer-friendly rule that it's really for purposes of this test, you need to do this balance sheet analysis, but it's really the value of the stock the value of the assets, the fair market value. And so, you can consider goodwill value as kind of a good asset. One big exclusion here is cash is generally not, a good asset for purposes of this test. Next slide. And so here, as I mentioned before, you needed to have 80% of your assets and used in a qualified trade or business. And so here, this is defined as defined by exclusion. So if you're in if you have any business that's A through E here, you're probably not going to qualify. But I do just want to point out that one company can have multiple trades or businesses. So maybe you have one trade or business that doesn't qualify, but your larger business does. And so generally a lot of service type businesses in certain areas don't qualify, but again, there's some nuance there. So for example, a trade or business in the performance of services in the field of health. You may think kind of anything in the field of health would be not a good trade or business, but there's rulings where, say you do diagnostic, work in the health field, that has been ruled on by the IRS that's okay. What they really mean by, performing service in the field of health is really kind of more like doctors. And not the kind of diagnostic type of services. And it looks like we have 1 minute left here, so I just want to see if anyone else has any questions for me or Mark or Bailey.
And I did want to just note, we did have one question in the chat about which states needed to enter the code. That was New York, New Jersey, Pennsylvania, and Kansas. You need to enter the code word finance in the chat if you have not already. But yes, I think we're right at 1, but if there are any quick questions, it looks like we might just have one here, which says, does 1202 treatment only apply to C corporations?
Generally, yes. And so if you're an S corporation, you probably don't qualify. But on the other hand, you could have started off as a partnership and then incorporated and became a C corporation. 1202 could apply there.
Well, we're right at the end, and we want to thank you all for your excellent attention and participation. Thank you for the good questions today. As we mentioned at the beginning, we are all here for you if you have any further questions or if anything that we talked about today piqued your interest. But I'm sure you're all looking forward to the next session, and we are as well. So we will kick it over to our Denton's team, our data and privacy team to go over the next session with you. And thank you all very much today. Great.
Allison, we can't hear you if you're speaking.
Well, while Allison gets the her microphone started up, we can kick things off with this next presentation. Brian, if you want to move to the next slide. Good afternoon, everyone. Thanks for joining us. My name is Peter Stockberger. I'm a partner in our San Diego office and a member of our data privacy and cybersecurity team. With me is Allison Bender from our Washington, D.C. office, who is our cybersecurity expert. Along with Rami Fayed from our DC office, who is our HIPAA expert. So the three of us are the dream team on data privacy and cybersecurity. And we are going to be walking through with you today trends that we are seeing both from a regulator standpoint, from a criminal standpoint, from a cybercrime standpoint, and from a compliance program standpoint. And we're going to be walking through with you our insights around at the state level, the federal level, and the international level. With that, there are some housekeeping items we want to have in order. We will be listing out a CLE code word midway through the presentation, so folks from New York, New Jersey, and the other jurisdictions that require that code word can pop it into the Q&A box. We'll also be answering questions throughout, so if you do have a question, please don't hesitate to pop it in to the Q&A box. Brian, if we go to the next slide. So I think to kick things off, before we dive into regulator trends, cyber crime trends, and the compliance program trends, it's first important for us to start with a landscape of US data privacy and cybersecurity laws. This will sort of set the table, I think, for all of the trends and insights that we're going to provide. And as many of you already know, there is no uniform data privacy or cybersecurity law in the US. And this really is something that distinguishes the US from the rest of the world. In Europe, we have the GDPR, which is a uniform data privacy law that applies across all EU member states. Other jurisdictions in Asia, in Africa, in Latin America have national level laws. In the US, we're much more fragmented at the federal and state level. On the federal side, I really break it down into 3 to 4 categories of data privacy laws. You have the general enforcement of unfair business practices by the Federal Trade Commission under the FTC Act. And the FTC will enforce that law against companies related to statements made in privacy policies, security incidents where they're not securing the data appropriately, things that the FTC considers to be an unfair business practice. Outside of the FTC Act, there's additional authorities that the FTC has to enforce laws such as COPPA for minor child data relating to the TCPA around telephone consumer protection. Then we move into the 2 sort of federal sectors, financial sector and healthcare sector. On the financial side, we have laws regulating financial institutions such as banks, insurance institutions under the GLBA, Fair Credit Reporting Act. And then we really have our healthcare bucket, which is Rami's bailiwick, and I think everybody's familiar with HIPAA, HITECH, and the related laws at the federal level. So at the federal level, we have the landscape really is focused on industries. At the state level, that's where we see a lot more action happening, both on the data privacy side and on the cybersecurity side. All 50 states have their own data breach notification law. Although they're similar, they all have their own fun little tweaks that you have to pay attention to in the wake of a security incident. You've got sister counterparts to the federal laws on children, healthcare, and finance. We have very specific cybersecurity rules developing at the states, including in New York with the DFS and other states regulating very specific industries. And one of the 2 areas that are really growing at the state level is around consumer data privacy laws and biometric privacy laws. The consumer data privacy laws are like the California Consumer Privacy Act, the CCPA, the California Privacy Rights Act, the CPRA, Colorado's new privacy law, Virginia's new privacy law. These are comprehensive omnibus data privacy laws that give the residents of those states affirmative rights over their data, right to know what data has been collected about them, the right to ask that that data be deleted, the right to opt out of that data being shared for advertising or other commercial purposes. And so this consumer data privacy bucket is really quickly growing, and so too is the biometric information category. And so those looking with that landscape, I wanted to provide you with some state regulator data points and state regulator insights. Allison's going to sort of give you the federal overview, and then Rami's got some real interesting insights around the healthcare point of view. At the state level, in my judgment, the enforcement trends really fall into 3 buckets. Data security in the event of security incidents or proactive security. Notice and consent issues around notifying people of their rights, privacy policy disclosures, notice at collections, and then failure to respond to consumers. On the first bucket on data security, we are seeing a proliferation of security incidents happening, but as well as reporting to the state officials. So just as a brief data point, 280 incidents were reported to the Washington State Attorney General, a 500% increase from 2020. That gives you a brief snapshot into how these states are increasingly seeing reporting happening. The trend of enforcing notices, enforcing response to consumers, we're seeing that through these consumer data privacy laws. Since 2018, 50% of US states have considered a consumer data privacy law. Only 3 have signed them into law. That's California, Colorado, and Virginia. But we have right now, as we talk today, almost 30 states with pending bills in the legislature at various stages, including East Coast, middle of the country, all the way to amendments on the West Coast. And so this area of regulation is fast moving. We have new enforcement authorities. For example, in California, there's the California Privacy Protection Agency that will begin enforcement next year. So this area of state consumer data privacy regulation is quickly moving ahead, and each of the regulators' offices in the 50 states are focused on data privacy, on notice, and on consumer rights. The other area that I think we're seeing a real trend in is around biometric laws. Now, these are laws that specifically govern the collection of biometric identifiers and biometric information. And here's the difference between the two. A biometric identifier is a specific piece of biometric information tied to an individual. So this would be your fingerprint, a facial scan, facial geometry. So the distance between your ear and your chin is very specific to you, would be a biometric identifier. And there are a lot of organizations that are actually picking up this data that you may not think about as biometrics. For example, if your organization uses software that trains your sales personnel on delivering better sales pitches, a lot of that software will give feedback on the person smiling too much or they're not smiling enough. That software that you're utilizing is scanning, in some instances, facial geometry. So you have to be thinking about on multiple levels whether there's a biometric identifier in your supply chain. Biometric information is information you derive from those identifiers. So you're making judgments about an individual based on the biometric information. The 50 state data security laws, they all regulate biometric information in theory, but we have very specific states that are looking at biometric laws. Illinois has a very robust biometric law that there are hundreds of lawsuits filed under that weekly. New York State has a specific law relating to employment. New York City has a new law on the collection of biometrics in the city and certain signage and consent requirements. We have cities like Portland and Baltimore implementing it. California has a draft bill now. So the short takeaway here is if your company is using any level of biometrics, you've got to pay close attention to that particular area of regulation because the regulators have their eye on it, and there are private rights of action really growing in this space. So the key takeaway here is we've got increased enforcement and focus on data privacy. It's got to be part of your organizational structure and your compliance program. Keep an eye on these developing state laws. The good news is that the 30 states that have pending laws right now, they're not going to take effect likely until 2024, even if they pass, with the exception of a handful. So looking into 2023, focused on California and Colorado and Virginia, but it's a fast growing area. And the final point, and Allison, I'll turn it over to you because it's a little bit of a political point, so it's a good transition into the federal look. It's a very interesting political landscape right now because you have red states and blue states both passing data privacy laws at the same time, and for different reasons. You have red states who want to stick it to the social media companies, and you have blue states who say they are doing it for consumer protection, but they're both passing these comprehensive data protection laws. And so it really is an interesting confluence of political objectives leading to this proliferation of state laws. So with that, Allison, with that state outlook, I want to turn it over to you. I see you got your mic and your technical problems fixed, fingers crossed, and we'll toss it over to you for a look at the federal landscape.
Thanks, Peter, and apologies for those technical difficulties earlier, but it sounds like you picked things up and glad to be back. When it comes to how the federal approach is really shifting towards consideration of comprehensive data privacy laws, as well as more niche cybersecurity laws, I think it just reflects that data is incredibly important to the current economy. It's important to consumers, it's important to business, it's important to regulators. We've seen not just the bills that are pending in state legislatures, but there are over 24 data privacy bills that have been introduced by this Congress with numerous bipartisan sponsors in both chambers. And actually, recently we just saw a federal incident notification law pass out of the Senate that would require critical infrastructure to report a data breach essentially within 72 hours of discovery. It was part of a prior National Defense Authorization Act, but it is continuing to resurface, and I expect that we'll see more legislation and regulation in this space. Additionally, regulators are already using the authorities that they have to step up their enforcement, both against criminals and against companies who have data practices that are more lax than they perceive to be the standard. Notably, in October of last year, the Department of Justice launched the Civil Cyber Fraud Initiative, basically working to use False Claims Act authority to pursue government contracts where the provision of services, products, etc., are some way not meeting the standards that have been set forth in the contract. We expect that to have a significant impact going forward. Every time you submit an invoice as a government contractor, that potentially could be a False Claims Act violation if you aren't meeting those standards. And we saw in 2020, DOJ collected $2.2 billion, but we expect that to increase. The SEC has also significantly expanded their enforcement. It really started hiring a lot of staff line attorneys for the enforcement division in SEC about 3 or 4 years ago. And we're now seeing how productive they all can be. In addition to a number of enforcement actions last year relating to privacy and cybersecurity, notably App Annie on privacy, First American and Pearson in cybersecurity. More recently, we've seen a $100 million SEC settlement with the crypto platform BlockFi for registration and disclosure failures. And we're also seeing a new proposed rule that would include a 48-hour breach notification requirement for certain types of computer security incidents. Part of the reason why there's so much interest by regulators in this area is because there are more and more significant breaches that are happening. And certainly with the headlines that we're seeing in the news, cyberspace has become a little bit more dangerous these days. Last year, there were almost 250,000 Microsoft Exchange servers impacted by a zero-day compromise that essentially resulted in whole of government response to address those issues. The government's also continuing to spend in this area, almost $800 billion authorized in the recent National Defense Authorization Act. I think that's likely to continue. In addition to the NDAA that I mentioned earlier, the Strengthening American Cybersecurity Act has passed, Cyber Exercise Act to bring both government and the private sector in to actually practice what it takes to respond to a data breach. And then a number of other items, for example, the Pipeline Security Act, which was largely a reaction to the Colonial Pipeline ransomware incident. Stop China IP Theft Act, which addresses concerns relating to cyber theft of intellectual property. And then also the Delete Act, which proposes a do not track list, similar to the SEC do not call list. It would provide broad scale data deletion rights, helping to protect consumers. It's not just what we're seeing in terms of regulation and legislation. There's also massive policy initiatives that are underway. Everything stemming from President Biden's executive order on improving the nation's cybersecurity, which largely was seen as a reaction to SolarWinds, but is a 15-page whopper of an executive order that sets forth an incredibly ambitious agenda for the administration and for executive agencies, largely to implement zero trust architecture and undertake a number of significant initiatives. We're seeing stronger enforcement. We're seeing more intelligence sharing. Certainly in recent weeks, we have seen the National Security Agency and other government officials much more quickly naming and shaming hackers, and also in many cases being successful in arresting them and being able to extradite them for prosecution. So all of these things match both the desire to kind of increase clarity on the requirements in cyberspace, as well as to take steps to make it safer by enforcement against those actors. Tommy, over to you.
Thanks, Allison. And just before I get started on this one, you know, it is kind of odd to have to talk about these topics in, you know, in this sectoral approach, but that's really the way, as Peter noted at the outset, the U.S. Privacy and security structure is set up, which is different than other parts of the globe, which may have a more omnibus approach to data. So although we're kind of breaking up the talking points and the discussion here between privacy and security issues on a larger scale that you're hearing both at the state and federal level from Allison and Peter, and then kind of a bit of a refined kind of focus on healthcare information from me, a lot of the same issues permeate whether it's healthcare or not, but we're just kind of approaching it this way, given that that's the sectoral approach that we have here in the United States. So with that, I think what we're seeing, in addition to all the other initiatives that have been talked about, is that healthcare organizations in particular, as they've continued to respond to the pandemic, cyber criminals can persist in their attacks on healthcare stakeholders because, frankly, those cyber criminals don't really care that there's an ongoing pandemic. And they continue to take advantage of the chaos that's been caused by the pandemic with no signs really of letting up on their part. And early in the pandemic, even the FBI had come out and issued a warning that criminals were actively manipulating the pandemic to their advantage. And the data really supports this. Healthcare providers continue to be the most targeted sector, accounting for almost 3/4 of reported breaches. And even with the pandemic pressures beginning to slowly show signs of letting up now, healthcare cybersecurity leaders continue to be overwhelmed with addressing cybersecurity challenges accelerated by the pandemic and their own budget difficulties. And of course, the government is aware of these challenges and faces its own pressures to push regulated entities to better comply with existing requirements and to try to drive the industry towards better practices to increase their focus on risk prevention and mitigation strategies. And as you can see from the data on this slide, 2021, not surprisingly, a very active year, over 26,000 complaint investigations that OCR looked into. And amongst the top issues that OCR really focused on in those complaints were involving impermissible uses and disclosures of PHI, safeguard deficiencies, and patient access issues, which we're really not going to focus on so much today, but it is among the agency's priorities to ensure patient access, which obviously does have a tangential reach to this topic, and that the more access points you have to data, the greater your risk is from external actors. Some of the other data points here, which are interesting just because of their sheer size, is that according to a Fortified Health Security report, there were over 500 healthcare entities that reported breaches involving 500 or more individuals, affecting over 23 million people this past year. And ransomware attacks in 2021 disrupted over 1,200 healthcare sites, which can, from a healthcare perspective, compromise care that's delivered, disrupt the use of EHR and equipment, and obviously creates significant patient safety concerns when you are locked out of your systems. And one of the main reasons that we see, even in 2022, that cyber criminals continue to target healthcare is because healthcare in general has outdated IT systems, historically few cybersecurity protocols, small IT staffs, and they have valuable data, which is obviously one of the big drivers. And there's a pressing need for hospitals to really pay the ransoms quickly in order to regain access to their data. And so all of those kind of confluence of events really put a target on the healthcare sector. And it's really no surprise then that we see that this surge of cyber activity has spurred a significant amount of legislative interest, with over 250 bills being prepared or introduced, with much of that legislation focused on requiring government agencies to implement cybersecurity training, better security policy standards, practices, better security incident response, increasing industry regulations, while specifically addressing now cybersecurity insurance to help mitigate some of the crippling costs associated with this, creating task force and so forth. So it's obviously a very active area, and subject to intense focus, given the fact that we are in this type of unprecedented onslaught of attack. And so as we think about what that really means in terms of what the priorities are that regulators are doing and how they are going to incentivize stakeholders to act, you know, the passage of the HITECH Act back in 2009 incentivized health IT technology to help modernize the U.S. healthcare system, leading to really an unprecedented connectivity in our healthcare devices and the expansion and use of other medical technologies. With EHR or health, electronic health records being at the core of most hospital or healthcare organizations in general, the digitizing of healthcare infrastructure has catalyzed major advancements that have allowed a lot of real great interoperability and longitudinal measurements of data and what have you, but it also has created significant opportunities for threat actors to attack these systems. And regulators continue, as I noted, to really look for ways to incent better behavior as it relates to their cybersecurity practices. And one of those that was passed last year was a amendment to the HITECH Act, which implements a safe harbor of sorts that requires the agency, when it's investigating a breach, to to consider recognized cybersecurity practices as part of the equation when evaluating the length and outcome of the audits or the amount of fines or the extent of penalties that will be imposed. The safe harbor didn't go as far as many people had hoped, where it would have prevented, OCR from imposing financial penalties. But nonetheless, it does require OCR to take that into consideration, what's been in place in the prior 12 months. And those, recognized security practices include many of the NIST and Cybersecurity Act of 2015 types of safeguards. So that is something that you start to see incentivizing many healthcare industry stakeholders now, following those standardized resources in order to take advantage of the leniency one gets if you have those, because there's no system, no matter how strong you make it, that would be completely immune to cybersecurity attacks. So having these good cybersecurity practices in place will help mitigate any of that regulator enforcement and penalties that one may face. Similarly, NIST itself continues to find ways to refine and enhance its processes. It put out a call for public comment to healthcare industry stakeholders so that it can improve its guide and awareness as it relates to healthcare matters. Specifically, OCR has issued a couple of newsletters this past year focusing on, some niche issues such as, controlling access to EPHI. Again, how you control access, how many people have access, those are all endpoints that can be, increase your exposure. And so managing that is an important initiative. And the second newsletter focused on protecting legacy systems, which is an often forgotten component of a healthcare stakeholders' security practices, because you have a lot of information that is retained on these legacy systems as you move to bigger and greater things, and those legacy systems tend to fall out of compliance. They become, not able to patch, or they expose security vulnerabilities that maybe you don't have in your current system, so they create a blind spot. So the newsletter was really to highlight the importance of securing legacy systems. And all of this is really driven by what consumers are saying, and that over 90% of consumers would switch providers if they found out that there was a breach of their information and they thought that the breach could have been prevented by the provider. So there is huge incentive to tighten practices and make your consumer, your patients feel safer about healthcare data. And with that, I think I send things back to Peter.
Yeah, thanks, Rami. An interesting through point on what you just discussed around, for example, the safe harbor rule for HIPAA data, and Allison, what you were mentioning about the SEC disclosure requirements, and then what I was previously talking about with state regulators, the through line is that regulators across industries are looking for you, the organization, to be maintaining reasonable security, commercially reasonable security appropriate to your industry. California, for example, has said reasonable security baseline is aligning yourself with what's known as the CIS controls, which is this set of 18 cybersecurity controls that the Attorney General's office has said that's baseline reasonable for an organization. But if you're in healthcare, as Rami mentioned, you're going to be subject to the HIPAA security rule. And so what these amendments, for example, on the safe harbor, or what the SEC is saying is, tell us where you're being reasonable. And I think that focus of the regulators, be reasonable, the reason why they're focused on that is because of this increase in cybercrime, this increase in vulnerabilities and attacks coming both at the US level, the international level, and specific to healthcare. So I think we want to focus a little bit on what are the trends in that space, both at the US level, and then Allison's going to talk briefly about the international threat landscape, and then again, Rami on the healthcare. But I think that sort of reasonableness is the through line here. And in the US, bottom line, we know that cybercrime is exploding. The average cost to respond to a data breach is continuing to balloon. The 2021 numbers are still being crunched, but just in 2020, the average cost to respond to a data breach was over $9 million, which is an extraordinary amount of money when you think about the time and the resources it takes to respond to one of these incidents. There's an increase in reports of identity theft. There are increased reports of ransomware attacks. So this need for the organization as a whole to view cybersecurity and data privacy as a core risk factor and an area to focus on reasonableness and controls and policies and testing is really important at this point, because the attack landscape in the US just continues to increase. An example from the FBI, a crime report, shows a real jump in increases of cyber crime being reported, in losses. California's sort of ground zero for cyber attacks. Being a California attorney, I can tell you that it's daily that there's phishing attempts, business email compromise attempts. So it is an ongoing battle in the US. And so the need to look at yourself as an organization holistically to see where your controls are measured against the threat landscape is really critically important in the US. And I think another important trend here is not only are businesses being attacked directly, but the supply chain is increasingly being attacked. And that supply chain risk, the vendor security risk, your partners, is increasingly becoming a risk that you as an organization are going to be held responsible for. It's what, to Allison's point, the SEC wants to know, are you examining that risk? And where is the risk in your supply chain? And so many of you have heard of the Log4j vulnerability that organizations are still dealing with. This is a vulnerability that impacts organizations down the supply chain, from Fortune 10 companies to medium-sized companies. The Kronos ransomware attack that impacted a very large HRIS system and payroll provider, impacting organizations' ability to deliver payroll to their employees. SolarWinds, which was highly publicized, that really impacted folks' ability to do business. It was a supply chain attack. And so the bottom line here is, if we're looking back at this through line of are you engaged in reasonable cybersecurity? If you look at whether it's the CIS framework, or it's the HIPAA framework, or it's the ISO framework internationally, each of these frameworks have as part of their requirements, are you actively reviewing the vulnerabilities in your supply chain? Are you reviewing the security practices of your vendors? And how are you holding your vendors accountable from a contractual standpoint and from a factual standpoint? And I think that's the real key takeaway here is just saying in a contract you will comply with reasonable security may not be enough for your particular organization. What are your audit rights? How are you ensuring that the security of your vendors is being ensured? And I think that's really a key takeaway here is when you are looking at your compliance program, you've got to focus on the downstream vendors and upstream vendors and have a program that can adequately look at the security in that space. So on the US side, the attacks are ongoing. One note that I would have arising from the Ukraine-Russia conflict at the moment, and I think, Allison, this transitions into your international view of the crime landscape, is that we are seeing an increase in ransomware actors announcing allegiance to state actors in this conflict and announcing that they will attack businesses who are perceived as jumping into the conflict. And I think that attack from potentially nation state actors or those quasi-state actors who are being supported by nation states can introduce some real complications around legal liability, in particular, and I won't dwell on it too much, but the force majeure clause in those contracts, acts of war, acts of government. If a third-party ransomware company hits you with ransomware and they've announced allegiance to a nation state, is that an act of war? Could you be left holding the bag under your contract? So it's something to pay close attention to as you review the conflict and see how it may impact your vendor stream. So with that, Allison, I'll turn to you for the more global viewpoint on the cyber crime landscape.
Absolutely. Thanks, Peter. We are going to touch on those things. In addition, of course, to what's in your contract when it comes to the force majeure clause, also reviewing the scope of coverage for your cybersecurity insurance policies may be helpful. There's been an increase in litigation related to cybersecurity insurance claims, in particular following the 2017 NotPetya incidents, which were attributed to Russia. We'll talk a little bit about kind of global statistics that we're seeing, and then discuss a handful of examples that may be useful to this group. Overall, globally, it's helpful to understand that it is still a very long period between when an attack occurs and then how long companies typically take to identify and fully contain a data breach. In 2020, that statistic was 287 days, which is longer than the NFL football season, even if you include the Super Bowl. So a long time period. Of course, if you break that down into segments from intrusion to detection, detection to response, it's shorter, but if an incident and when an incident happens, it's going to have a long latency effect on your daily and weekly agenda. It's also incredibly expensive. Globally, ransomware incidents cost the global economy an estimated $20 billion, which is another reason why regulators and criminals are so focused on this particular threat. It's not just ransomware, though. Business email compromises typically don't get the same type of headlines that ransomware does, but they're still incredibly expensive. On average, they result in nearly a $1.2 million payment to threat actors. But I can tell you from experience, when you borrow money from the line of credit to pay the threat actors, it actually can end up being a lot more. And we've seen that, unfortunately, with our clients and also in industry. Even just everyday phishing attacks. Don't click on that link. Hover over the email address to see if it's actually a person you know, rather than a fraudster imposing. Still cost businesses quite a bit of money. If you break it out in terms of lost productivity, training, reporting phishing incidents, on average, it's about $1,500 per employee in 2020. Those costs do pay dividends in helping prevent these types of attacks. Phishing is still the most common attack vector for most types of cybersecurity incidents, but it's not just IT, it's not just legal that is focusing on these issues. It's having an impact on, everyone from the receptionist all the way up. Of the companies that detected ransomware attacks, 54%, they did say that the criminals succeeded in encrypting the data. So once they're in, it's generally easy for them to have their way with your network, which means it's even more important to protect yourself and hopefully prevent that from happening. When we look at some of the cases from around the world, who are the threat actors? There are a wide range, everyone from opportunistic cyber criminals to more organized gangs to hacktivists that maybe are intent on causing vandalism for a cause-related issue, but also nation-state actors and their proxies. When we think back to some of the highlights from the past year or two, SolarWinds, which was December 2020, ultimately was attributed to Russian state actors, their most elite cybersecurity unit. The Microsoft Exchange hack that I mentioned earlier was attributed to Chinese state actors. And as we see things unfolding with global events, particularly the activities in Ukraine, proxy actors and potentially patriotic but independent actors are entering into the fray online. Peter mentioned this earlier, but I think it's worth repeating. For example, the Conti ransomware group has come out and posted on their ransomware threat actor news page that they will be officially supporting Russia in the conflict. And then if there are any attacks on Russian critical infrastructure, that those types of attacks will be returned in kind on the United States. And for victims of their prior attacks that didn't pay for their data to be released, but still didn't see it on the leak site, apparently they will now be selling that data. And others have joined the fray as well. Lockbit has also announced that they'll cooperate with Conti in favor of Russian actors. Anonymous has taken more of a defense view, attacking Russia and protecting Ukraine. With all of that activity, not just from nation states, but from independent actors who maybe do their day job and then go home and hack under the anonymous banner later at night, cyberspace is getting more complex, and the likelihood that one of those actions or many of them will have spillover effects, compromising essentially innocent bystander civilian networks and data, becomes increasingly likely. So while things are getting more complex, certainly we have also seen more arrests, more indictments, more international cooperation than I think we've ever seen in cyberspace. We've started to see the return of seized cryptocurrency. In some cases, threat actor groups have decided that law enforcement has been putting a little too much heat in the kitchen and it's time to retire, and they've been sending out decryptors to past victims to unlock their data. There are numerous examples from the headlines where these types of law enforcement activities have been making an impact, and I expect that pressure to continue increasing. It's not always personal data that is the target of an attack, although certainly the value of 1,000 social security numbers on the dark web, I think, is $8 now. If you have someone's health record, it's far more than that. I think it's almost $200 because it's so much easier to fake someone's identity when you have all of that information. But intellectual property, there's no data breach notification law that requires disclosure. And so I think people have less awareness that it is still happening, and it has only increased during the pandemic, particularly for pharmaceutical and life sciences companies, also companies that are in emerging technology sectors like artificial intelligence and quantum computing. I've been seeing an increase in misappropriation of intellectual property, whether by trusted insiders or through cybersecurity attacks. And this quote is from a couple of years ago, 2017, but from General Keith Alexander, who said, the value of theft of intellectual property from American industry represents the single greatest transfer of wealth in history. And so just as a word of advice, if you think that you're too small for someone to notice, you won't be hacked. There are now search engines for vulnerabilities. There are bots. There are automation tools for threat actors where you may just be a crime of opportunity, but you can't rely on being unnoticed in cyberspace anymore.
Hey, Allison, before we toss it over to Rami on the healthcare side, and I think it kind of ties into the healthcare, one thing you just mentioned about intellectual property and also who's accountable for the attack itself. To me, a couple takeaways there from a contractual standpoint, the two areas in your contracts, regardless of who they're with, that you have to pay attention to. One, obviously, the confidentiality provision protecting your IP and trade secrets, but it's the consequential damage waiver in most contracts. You see it almost in every contract. Both parties waive consequential, incidental, special damages. And courts have said across the country that if the underlying damage or cost is not the direct purpose of the contract, it may be deemed a consequential or special damage. So when you are suffering a data breach or an incident, whether you are trying to hold somebody accountable or somebody's trying to hold you accountable, the costs of that, the investigative costs, the lawyer costs, the forensic costs, it all may be considered consequential or special if the underlying contract's not dedicated to security. So that's one area. I think what you just mentioned about intellectual property is really paying close attention to those provisions, thinking about which side of the coin you're on, and thinking through the worst case scenario and how you can ensure that you'll be able to recover in that scenario. And I think that, Rami, to your probably on the healthcare side, that ties in directly to business associate agreements and the accountability there.
Yeah, certainly. Just briefly, certainly on the contract points, makes a lot of sense. In addition to that, being prepared and practicing your incident response can make a huge difference. There was a 2018 study that found that companies who are able to respond to a data breach in 30 days, on average, save $1 million from the average breach cost. And just having an incident response plan for large companies can save up to $300,000 off of costs. So those things combined with a very proactive and thoughtful risk mitigation strategy, risk management strategy, risk shifting strategy really make a lot of difference. In particular in healthcare.
Well, thanks, guys. Well, as we continue our theme here of kind of following the data, we're just going to dig into a couple of healthcare-specific cybercrime data points. And again, awareness of these data points is important for healthcare stakeholders, not only just because these are valuable data endpoints which help inform you about what you should or shouldn't be doing. They are also important because they influence how regulators act and even how criminals choose to act and where they perceive the greatest opportunities may be. And again, when you look at some of the data just from this past year, and it's not fully baked yet, but it's preliminary as it's being compiled, almost 45 million individuals were impacted by some form of healthcare data breach, with nearly 3/4 of them involving some type of hacking incident. And, aside from the technology deficiencies and pressures to pay to restore functionality that are common in the healthcare industry, there are other factors that are contributing to the higher rate of attack that we see in the healthcare industry. And as Allison kind of noted in her last slide, really the value here is that medical records are a hot commodity and on the dark web. And why is that? Well, they're more valuable than credit cards and Social Security numbers because those are financial data points that are cancelable, can be changed. Medical records contain and retain their value regardless of anything you do in the future because they're a treasure trove of unalterable data points. And your medical history, your behavioral history, your demographics, contact information, all of that information can be used to obtain illegal prescriptions. You can file bogus medical claims. And of course, you can steal patient identities. So it is a crime of opportunity in that it is more valuable. It provides more ways in which to cause harm and create money opportunities for those criminals. And frankly, I can't remember now if it was Allison's slide or Peter's slide that had an average data breach cost. When you look at average data breach costs in healthcare, they're actually slightly higher than if you exclude, when you look at other ones, we're roughly around 9.4 million versus closer to 9 million for non-healthcare data breaches. So breaches are more costly in healthcare. More people are affected. Most of the breaches that we've seen involved either stolen login credentials, and this type of breach took longer to identify, roughly about 250 days, and 20% cited remote work conditions as a cause. And those types of breaches cost roughly 15% more than other types of breaches. So the cost of investigating, the cost of recovery, the cost of the data theft, all of those components make healthcare data breaches roughly 30% higher than the next highest, which might involve financial sector data breaches. And the downtime costs associated with it, roughly $21 billion in downtime associated with healthcare, which is double what that was just a year prior to that. So where does all this trend us? Where does all this, bringing us, and where do we think we're going with this? Well, one of the challenges we face in making predictions, aside from the prediction that cybercrime will continue, is that we don't really have a stable baseline off of which to judge the year-to-year changes. Every year presents different variables that are making it difficult to properly trend. What we know for sure is that the digitizing of the healthcare infrastructure, the expansion of virtual services like telemedicine, connectivity of more and more medical equipment and devices are creating a significantly larger attack surface. And so the vulnerability continues to go up because the institutions don't have control over everything to which they're exposed. And if we're kind of reaching into our crystal ball here, which is probably not a great crystal ball, the expectations are that cybercrime in the next few years here is expected to triple. And the frightening part is that nearly 3/4 of healthcare providers surveyed reported that they may not be prepared to respond. So with numbers that are expected to triple and the inability to respond, getting back to some of the earlier points we were making about having reasonable security practices, what are you doing to put yourself in a better position? This is the time that if you haven't started, if your organization hasn't put the resources into those security practices and policies and procedures and incident response plans and what have you, really this is the time to do it. And as Peter noted when he was talking about the Log4j and the supply chain issues, supply chain in healthcare is another critical exposure area because healthcare providers rely on an extensive network of supply chain partners who have access to identifiable health information. And so supply chain management is another high-risk exposure point for providers, requiring them to invest in a lot more security assessments of those vendors. So not only do they have to worry about their own security risk assessments and their own vulnerability management, now they have to worry about all of these downstream vendors who are creating more and more access points for them. And the techniques that providers or that criminals are using are also expanding. So we're moving away from the spray and pray type of approach where you just kind of hit and see what you get to the real more big game hunting, where these are slow, methodical attempts. They've been building up. And at some point, whether it's here in the near future or not, because these are very patient attacks, are going to spring up, and they're going to be a lot more crippling and damaging to those entities affected because they've been carefully cultivated and targeted because of the high value of the data, the volume of data that they may have. And if that type of data set is encrypted and you don't have a good incident response plan, a good disaster recovery that will allow you to maintain the continuity of your operations to ensure patient safety and the continuity of care, it's going to create enormous challenges. And this is not going away with the expansion of the 5G networks, Internet of Medical Things devices that are constantly being added to the network. All of these create an open healthcare and public healthcare sector that is ripe for further attacks and potential compromise. And with that kind of grim outlook, I'm going to hand it back over to Allison, maybe for something more upbeat.
The most upbeat part of this presentation, your CLE code word is March. You're licensed in Kansas, New York, New Jersey, or Pennsylvania. Please enter the CLE code word in the Q&A box on the right side of your screen. And the CLE code word is March. So with that, I think we're going to shift into how compliance programs follow the data, whether that's state, federal, or health compliance and data points and priorities. And that, Peter, do you want to kick us off here?
Sure. So I think one of the core features of any security compliance program, which Allison's mentioned, Rami, this reasonableness standpoint, are some pretty basic common sense features. Security awareness training. We see data that shows 50%. You can reduce your threat of a cyber attack by 50% if you increase your security awareness training, phishing training. Incident response plan capability, having the plan in place, testing it, running tabletops, increases your costs by over 50%. And so you see a number of these data points that cybersecurity compliance has to be part of the organizational design, security by design. It's no longer just an IT security issue. It's got to be done in compliance with the privacy group and also with the compliance group more generally, General Counsel's office. So a security compliance program is really essential at this stage in the game. And from a general security standpoint, Rami, what are some compliance programs that you see on the healthcare side that would be helpful? And then I can offer some insights on the state data privacy trend in compliance as well.
Sure, and again, we'll talk about that now. We don't really need to worry about the slide on this, but fundamentally within healthcare, when you evaluate this from the perspective of what is the government going after, that kind of gives you insight into what your compliance program should have and what types of deficiencies are the most common. And the biggest deficiency that we see is the failure for organizations to conduct risk analyses. That is a critical component of your ability to know what's working, what your threats are, what your vulnerabilities are, and that is by far one of the top items that the government looks into. One of the first things they ask for when you're being audited by the government is a copy of your most recent security risk analysis. So I would say that's probably one of the big ticket items, Peter, along with what's your risk management plan. Those seem to be the big ticket items that we're seeing. And the two settlements that I included here, again, they're not necessarily intended to pick on specific entities for getting in trouble with the government, but they do highlight, when you look at the deficiencies on the slide, all of the things we're talking about, the failures to have risk analyses, risk management plans. What are your security policies and procedures? Are you training your workforce? Are you exposing them to drills that, where they can be targeted by internal kind of phishing attempts from your own IT department to see how well they're absorbing their training? Are you investigating reports of potential attacks or intrusions into your system? And if you're confirming that something happens, are you reporting those to OCR? Those are kind of the big ticket items, and those themes are repeated in both settlements. There are different types of entities in both, but when you go through the list, you'll see a remarkable similarity in the types of issues and failures that they have.
Yeah, and I would say at a state level, so going back to the first part of the presentation on these developments in state consumer privacy laws, key takeaways here are start preparing now. Even though a number of these laws don't take effect until 2023, it takes a lot of coding, a lot of policy development. You need to be proactive in developing your compliance program. You need to start mapping your data, understanding where consumer data is going, what vendors are handling it, and you have to make strategic considerations. Are you going to extend California privacy rights to the rest of the country? Are you going to just take a whack-a-mole approach with Colorado, California, and Virginia? And how are you going to treat employees and your contractors? The California law is scheduled to cover employees. Most other laws exempt them. Are you going to develop a privacy program for your employees and your contractors? These are key strategic decisions to make now. The two other final points that I would raise: cookies and ad tech and digital collection. It's increasingly the focus of regulators. How you are collecting data for advertising can really impact your compliance under these laws. So it's not an area to ignore. Don't sleep on the security, because the reasonable securityness requirement is really what regulators are looking at. And documenting your processes and your policies and your plans It's really critical for these state laws. So a lot there to digest, but there's enough time to plan for 2023 on these state laws. And Allison, in our last minute, over to you for a look at the broader compliance program, kind of key takeaways as we wrap it up.
Allison, before you jump into that, I can't reiterate the importance of Peter's last point there about ad tech and cookies enough, because healthcare in general has been late to the marketing game, the CRM types of activities. It's something that in the last couple of years, they've really started to take hold. How do we reach, treating patients more like consumers and reaching them in that same way? And that move, because they're kind of coming to it new, I think awareness of those concepts and what those mean, critically important and should not be underestimated in the healthcare space. Sorry, Allison, to take up your minute there.
No, that's great. I think all of those points apply. Privacy and cybersecurity are really two sides of the same coin. Personal data and data generally, if you collect it, you have to protect it. Minimization, deletion, documentation, and continuous risk management, as well as training, are going to be incredibly helpful to you, regardless of sector and regardless of the type of data. If there are any questions, we're happy to stay on the line for a minute or two. But otherwise, thank you so much for your attendance. And Peter, Rami, and I would be happy to help you with any questions or issues that you all may have. All right, thank you.
Thanks, everyone.